But when we look at the Super Investor Index, this is not the case. Super Investor Index has higher return than portfolios in the efficient frontier, given a certain volatility level. It implies that S&P 500 is not an efficient portfolio, at least not as efficient as not as efficient as Super Investor Index. Even when we allow to add risk-free assets, the new efficient frontier capital market line is still under Super Investor Index. So, under modern portfolio theory, Super Investor Index again performs better than than Market Index. This is the same case with Russell 2000 and Wilshire 5000. I also do efficient frontier analysis based on a 5-year and 10-year framework. They are a little bit different from 20-year performance. The Super Investor Index is not far outside the efficient frontier, and it is even always under the capital market line. I take this as the result of the value investor's long-term focused object. So, after the return and efficient frontier analysis, I think we could make the statement that Super Investor Index outperform Value Index in the long run. So, what leads to the success of value investors? Margin of safety is the first word comes out of my mind. Luckily, Ben Graham also thinks so. He said, if you were to distill the secret of sound investment into 3 words, weave into the model. Margin of safety. Purchasing at a discount to its intrinsic value is not enough. Successful value investors would ask, is this discount sufficient? Since it is possible that the value of a company may decline, good investors should have margin of safety that allow for human error, unpredictable and rapidly changing world. So, buying a stock with a margin of safety means paying a favorable price that reduces the downside risk and increases the upside potential. The concept of margin of safety really focuses on the idea that never loses money. I actually think that it is margin of safety that allows value investors survive in the market downturn, thus making their performance significantly better than market. Also, margin of safety explains the asset concentration for some value investors because they believe the extreme margin of safety of one certain asset really controls the risk. Well, while I think margin of safety is what value investors want to have, patience is how they get it. Patience lies down the road of value investing everywhere. The process starts by studying a company to determine its business value, then waiting until the market price reaches a discount deep enough to warrant a purchase, believing in yourself and ignoring the doubts when the market trends are going to the other direction, and then holding the stock until they approach their intrinsic value. All these require patience. Value investors will succeed in the long run if they have patience. Investors who lack it may take 2 vital mistakes: buy high and sell low. So I really think patience is as much important as margin of safety. So, if someone who believes market is efficient, that the margin of safety makes no sense, or someone who can't wait for years because he or she may need money right now to support the family, I don't think value investing is suitable for them. They may choose to follow an index, letting other people determine their gains and loss, or they can find a casino, wishing to become a millionaire by gambling or speculating. For me, I would definitely try value investing. If I am to invest, in the preparation for this presentation, my mind is really refreshed. In the past 6 years, all I learned is based on efficient market hypothesis and diversification. We wrote my lab codes to construct diversified portfolios and model option pricing. This work looks good because they can be written in mathematical formulas and easier to analyze. Value investing is really not only science but art. I definitely have passion to dig out a company, to try to know something about a company rather than just collect a bunch of historical numbers or follow an index that I hardly understand. I have time and patience, and I think I have the ability to analyze the company from fundamental aspect, even though I have much more to learn. Value investing is something that can light me up. As for my parents, I would not recommend them to do individual value investing, though I will persuade them to believe in this idea that value investing supports. I think a value mutual fund is better for them. Their lack of financial knowledge, so it is hard for them to understand the company they are going to invest. Also, they have no sufficient time to do this complicated analysis because they are not working for a financial company. So I think the good choice for them is to invest money in a fund. Choose a reliable manager who believes in value investing strategy. So here is my presentation and this the appendix. So thank you so much and have a great day.